Good morning, everyone. First of all, very glad to be back at the Digital Asset Forum after 1 year. And secondly, most importantly, what a fantastic year it has been for digital asset and the overall crypto community. We started last year with crypto ETF approvals in the US, then we saw some sort of regulatory clarity around the world, although we are still far from being perfect, but at least we saw developments in that direction for sure. And lastly, we saw like massive adoption from institutions, be it like traditional hedge funds or family offices and other high net worth individuals as well. In today's crypto ecosystem, one of the most important things is to how to build and scale institutional level crypto products. To discuss that, without further ado, I would like to introduce my panel. We start introductions with Jennifer.
In 2018, I was the chief operating officer for a global bond firm. We traded the first fixed income instrument that was issued and settled on a blockchain infrastructure through JP Morgan. It was National Bank of Canada. That was when I really understood what digital assets could do and what they could mean. That was a long time ago, though. I think I thought it was going to go a lot faster. But I left traditional finance in 2021 to start a firm to manage digital assets in a liquid format. So we run 2 liquid token products.
Matt Howell, I work for T. Rowe Price. T. Rowe Price is a large US-based asset management firm. My day job is looking after everything derivative related at T. Rowe. But over the last couple of years, I've been lucky enough to work with Blue Masalari and her team as we've focused on building out our capabilities in digital assets.
Hello, my name is Bradley Duke. I'm head of Europe at Bitwise. My journey in crypto started back in 2019 when I was one of the founders of ETC Group, a pure play crypto ETP issuer, which was acquired by Bitwise about 6-7 months ago now. And Bitwise is one of the largest asset managers, digital asset managers globally, with a very large presence in the US, and of course here in Europe we've got many products that were produced for institutional and retail investors. So that's always the goal. Wherever possible, we would like to have a product that's accessible to the retail investor. And we try to produce best-in-class products wherever possible.
I'm Michelle O'Connor. I run global expansion at Taxbit. We are a tax and accounting compliance solution for enterprise audience. Before joining Taxbit, was at a company called BitReserve that then turned into Uphold. I started there in 2013. So to some of my panelists' points, it's been an interesting ride and a little bit slower than we would have liked, but I'm excited to talk today.
Hello, everyone. For the eagle-eyed viewers, that I am not actually Paul Frost-Smith. Our Komainu CEO unfortunately called in sick today. So my name is Darren Jordan, Chief Commercial Officer of Komainu. Komainu itself is a regulated digital asset custodian, backed by Nomura and our more recent investors, Blockstream. Myself, I've been lucky to be in the digital asset space for custody business for the last 7 years, in various number of different regulated custodians. And then previous to that, my background is traditional finance, both on the buy side and sell side. Komainu not only provides regulated custody for institutions, but we also focus on providing utility service, which sit on top of custody. That includes staking, but also collateral management solutions, and various other solutions that institutions are interested in. So pleasure to be here.
Thank you for the introduction. Jennifer, we'll start with you. When you talk about crypto asset management, it is relatively new as compared to traditional asset management, because some of the companies in traditional asset management space, they have been here for decades, if not some of them from centuries. When you talk to institutional investors, what do they look for in a digital asset manager?
In my experience, institutions are not looking for a digital asset manager. They want exposure to digital assets without the operational risk, without the reputational risk, without the regulatory risk, and without the volatility. So they really want anything but digital asset management. And you see that the evidence for that is venture capital. Most institutions that are interested in crypto are invested in venture capital. It's an existing bucket they have. They understand it. It lacks liquidity and transparency. It's one decision for 10 years. I just talked to an institution, a foundation, large foundation in the United States. The woman responsible for their digital asset strategy told me I allocated to this venture capital fund, and I probably won't be here when it starts, realizing its returns. So low reputational risk for her, So venture capital funds in crypto are many multiples of the size of liquid funds. That's exactly reversed from traditional markets. I expect that to change over time, but that's the situation right now. You also see it in equity markets. The MicroStrategy, which you might be familiar with, is a stock with a market cap of less than $100 billion. Its trading volumes are on par with the Magnificent Seven in the US right now. So the institutions are sort of looking for ways to get exposure without having to say, we invest directly, for example, in Bitcoin or other digital assets. So you also see it in ETFs. The ETFs for digital assets, Bitcoin specifically, are the most successful ETF launches ever. There's some evidence that institutions aren't even there yet. Most of that has been people who never owned an iShare. Most of BlackRock's sales of ETFs have been to people who haven't owned an iShare before. So some evidence that institutions are coming in through ETFs, but really mostly through venture capital and through equities. We had an endowment, large university endowment we've been talking to for 3 years, asked us last week on a call, would you consider investing in US equities instead? So that's what I see in the market currently.
Thank you. Matt, you are someone who has been associated with trading of traditional assets, be it like commodities or equity market and all. How different is, from institutional perspective, how different is trading digital assets as compared to some of the traditional assets?
So I've been lucky over the course of my career to be able to trade pretty much every asset class under the sun and the derivatives thereof. And crypto and digital assets bring a unique set of challenges and opportunities. In some ways, they're very similar to certain asset classes, certain equity markets that have ID and pre-funding kind of requirements. There's similar kind of characteristics. But in general, there's a lot of areas of opportunity to rethink the way that we traditionally trade things. So you don't have to deal with managing gas fees. You don't have to think necessarily about how you're funding. You're dealing with a settlement cycle that is orders of magnitude faster than any other asset class that you're trading in. And with those opportunities comes a real chance to break down the way that you engage with the asset class and take it from scratch and really rethink and challenge the way that you traditionally do your business and traditionally trade it. And that's been our approach, is so rather than trying to think about how we integrate the asset class into existing workflows and existing trading infrastructure, we've been going out there and thinking about it with a blank sheet of paper. What do we need to do to make this asset class work for us and enable us to invest?
And Bradley, we'll now discuss, because you have been associated with the digital asset market for some years now, and Bitwise is a big name for sure. As I mentioned earlier, that the approval of Bitcoin ETFs in the US kind of changed literally everything from institutional perspective. What sort of clients are now entering the digital asset space as compared with a couple of years ago? Obviously, we heard about all these large traditional hedge funds entering the market with like billions of dollars worth of Bitcoin ETFs, but at the same time, family offices as well. From your perspective, the people you talk to, what sort of clients are now coming in?
Well, it's been an interesting journey so far. The products that we have at Bitwise were designed with the institutions in mind. That a risk committee or investment committee would look at the products, under the due diligence process and come out the other side and say, tick, 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 we are happy to invest in this product. And so that's always been the driver behind it. But at the same time, we understand that this is first and foremost, a grassroots retail investment phenomenon crypto has been, in terms of who are the early investors. And actually, as you move up the value chain, because everyone's got different definition of what an institutional investor actually is, but where it's actually the clients that are calling the shots and have a direct, have a choice. If they're, for example, wealth management or private banks or even family offices, they get to say, I want to invest in crypto. And if you're in a wealth management or private bank and they say, oh, sorry, we don't support those products, they can just move their money and go somewhere else. So it actually becomes a career risk for the manager not to be up to speed and familiar with crypto and have that as part of the offering. Further upstream, it becomes more difficult because, of course, the true institutional investor is very slow moving, very conservative, and they have the flip of that career risk where they don't want to be the early mover in crypto. But I think this is starting to, over time, we're starting to see more interest from sovereigns. We're starting to see more interest from insurance companies, from pensions. And they may not be ready and coming in now, but they're definitely dipping their toe. And as Jennifer mentioned, they are getting exposure through other vehicles like MSTR and other increasingly more and more companies that are holding Bitcoin as treasury assets. And so to answer your question, we're seeing everybody all the way up, certainly specialist hedge funds, certainly family offices, and definitely the wealth management and private banking businesses are very much involved already. But the true institutional is still on the fringes and waiting on the wings, but they are informing themselves. They know this is coming.
Do you think regulation is the reason that they're still waiting? They want some sort of regulatory clarity?
I think it's part of it. And of course, now we're seeing a big shift in the States. In terms of towards positive view on regulation and which we didn't have in the previous administration, unfortunately, and that seems to have flipped now. In Europe, we've got this is 2025 is the start of MiCAR. The regulation is in place now across Europe, which definitely helps because it gives investors clarity about the types of companies that are operating within the space. Of course, in the UK, we still have the FCA's ban for retail investors, which I think has really set us back in the UK in terms of where we are, and investors have had to search for other direct investment or unregulated products to get their exposure to crypto.
And Michelle, we're talking about we're getting some sort of regulatory clarity in different regions. And with that, we're getting some sort of clarity around the tax treatment of digital assets as well. You work with a wide range of institutional clients and also different authorities as well. What are the sort of clients that you work with, and what do they ask for when they want a tax and accounting sort of product related to digital assets?
Sure. So before we jump in there, something that's interesting and that we see of why I think a lot of the larger institutions, especially in the US, want to play, but they don't want to go entirely in. It is for the reasons of risk and volatility, but it's also transparency. So because everything is on chain, until there's a level of ZK or an anonymity, a lot of institutions say to us they're not comfortable because it's all entirely public and accessible. So that's one of the things that we hear a lot is we're interested in this, but you can reverse engineer, and through companies, you can see what we have when we have it, the value. So that's one of the things that we hear a lot of concerns because we deal with all of their data. On the accounting side, recently, some of you might have seen Tesla had quite a big windfall through investing in Bitcoin. So a lot of companies have come to us in real time with a recent regulation change on the accounting side and said, how do we put this on books, but then ensure that we're compliant, and how do we get the benefit of the windfalls, but ensure that we have everything in real time because there's all this volatility. So it's taking something that's complex and moves so much faster than traditional financial teams are used to and streamlining it. It actually optimizes it and makes them able to process things a lot faster and in real time identify savings opportunities. So that's something that we enjoy hearing from our clients is they were able to realize savings or write-offs that they otherwise would have missed. On the tax side, the US recently, the new administration is promising to be pro-crypto. The recent executive order that came out pushes that way, so we're really excited about that. One of the things that has been interesting as a US-based company that has expanded globally, Europe really had set the standard with MiCA, and it was really, we were all watching going, oh my goodness, this is, when can we get there? So 2025, 2026 are really busy for us as a company because there are all these compliance deadlines. And if you look at the US versus Europe, it's a real interesting personality shift. US has regulatory timelines and they're complying, whereas Europe is more partnering because the regulators have been more in partnership with the industry. So that's what's really interesting in the differentiation.
And do you think this partnership can help, this same model can help in the US as well? A partnership with industry?
Absolutely. We're already seeing it quite a bit.
And Dan, crypto custody, I mean, institutions have been interested in crypto custody for a while now. As a crypto custodian, what you have seen in the recent years, do you think institutions are now feeling more secure about the custody of the digital assets as compared to like a few years ago?
Yeah, I mean, I'm very lucky, I guess, is that 7 years ago I joined a wallet provider that was based in the US that then became a regulated custodian. So I've seen over the past 7 years the market develop in a number of different ways. And back in the very beginning, regulated custody was far and few between, and a number of institutions that were testing or dipping their toe into the market were using maybe physical devices or self-managed custody solutions. There was no governance controls. They were leaving assets on exchange. And if you think over the last, well, certainly post-FTX, appetite has changed in a number of different areas, specifically around, I would say, and it's relevant because a few of the points mentioned from some of the panelists. So, regulation 7 years ago was trying to shoehorn a product into an existing framework, for example, a US trust. The actual regulators had no real idea of what digital assets were, but it was squeezed into an existing regulatory framework. Now, that didn't really tick all the boxes for a number of institutional investors for obvious reasons. So I think if we look at regulation, whether we like it or loathe it, that has vastly improved over the last 2 to 3 years, specifically in certain jurisdictions that have fully embraced digital assets with a very bespoke regulatory framework. For example, UAE and Dubai, VARA was set up specifically to cover digital assets. And we're also seeing that in other regulatory jurisdictions as well. And I think if we look outside of regulation, we also look at technology. And I remember a lot of discussions around MPC, multi-sig, HSM. It's a difficult one for any institution to get their head around which is better, which is worse, which is more secure, which is less secure. And I think in the earlier days, a lot of that technology was largely untested and very, very new. MPC, for example, versus multi-sig was an ongoing debate for a number of years. And I think where we are right now is that technology has proven itself for the positives and different variances of different types of MPC versus multi-sig. And I think overall, the actual quality and the security and enhances in cryptographic technology means that actually technology-wise, they're all very, very secure as a baseline tech stack, although it obviously does require a governance control framework to be added on top, which is obviously what a custodian does. And then I think the other component is really around connectivity to partners that offer services, OMS, whether it be portfolio reconciliation, tax, the list goes on and on. That didn't exist back in the day. And for some of the larger institutions, this is fundamental, how they process transactions and reporting in their back office systems. And suddenly putting a new asset class that they didn't have APIs to connect into in their existing infrastructure was massively problematic. That is dramatically shifted now. And I think the other part of connectivity really with regards to solving counterparty risk, or at least minimizing counterparty risk around your trading partners, be it exchanges, be it prime providers. And you're seeing a number of interesting options out there. It's something that Komainu's been running as well as other custodians, where clients can hold their assets sitting on an exchange and mirror them. And the same with any secure party. So I think with all those coming together, the actual infrastructure has massively changed in the favor of institutions. And I think we're seeing that as reflected in the wider adoption in new products, but also price movements and some of the interesting products like tokenized money market funds, BlackRock, UBS, the list goes on and on. So it's vastly different over the last 2 to 3 years in particular.
And yeah, Jennifer, you want to say something? I have a question for all of you guys. Just imagine all of you are starting from scratch. If you were to build an institutional level digital asset product, how would you go about it? We'll start with you, Jenny.
In the late 90s, Amazon went public, and Jeff Bezos' letter to shareholders is iconic now, his initial letter. And in it, he essentially said, we're not going to make profits for many, many years. So that was his sales pitch to investors. Shortly after that, you may remember there was a Fortune or Forbes, cover article, Amazon.bomb, and it was a very controversial stock for many years as he sort of built out the platform that he envisioned, not the bookseller that people initially thought it was. I think, Bilal, what happened in crypto is most of the very successful products that actually have real use cases were highly motivated to convince everyone that they were not securities. And the main way they did that is not charge fees, not have revenues, not have profits. And Uniswap's a great example of that. So here you have something that is sort of trading on volumes often similar to Coinbase that trades at 20% of the market capitalization of Coinbase, for example. And but the token, when you explain to an institution, this token, well, it's a governance token. It's not really clear. We don't have any claim on anything really. So there's a lot of controversy around the economics because all of the economics were designed to avoid being called a security. Now with this new administration in the United States, I think we'll let go of a lot of that. We just wrote a piece for the CFA Society that they published last week on how now new tokens are designing their economics to be much more familiar. They look a lot like equity economics. They do things like buybacks and other sort of ways, dividend yield, ways that equity investors are familiar with getting returns. So I think in answer to your question, it would have been much better if we could have designed tokens from the beginning to show real economics to token holders. We weren't able to do that, but I think we'll get a lot of momentum from that now.
Matt?
Thank you. I think that Jennifer makes a great point around building clarity on the path to expected returns. I think that's key for institutional adoption. The other thing embedded in the question was like, what would you do if you started from scratch? That's kind of what we did, and that enabled us in a way that we wouldn't have been able to pick best of breed providers going into our tech stack right from the start, and to get involved and move quickly and test and learn and iterate in a way that if we tried to be integrating this asset class into our legacy systems, legacy stack, we simply would be still talking about it at this point, and we wouldn't have had the operational capability to trade 20 tokens across multiple blockchains for the best part of the last year. So I think that's the from scratch kind of idea is absolutely key. It is a different technology, it is a different capability, and having that kind of front to back operational view that is fit for purpose for digital assets has been a massive enabler for us. And then it's also going to enable us to build the operational capability that will allow us to move forward with institutional grade product.
Bradley?
Well, so a lot of the people at Bitwise and the former ETC group, like myself, have a traditional finance background. We're passionate about crypto, but we have a TradFi background, and and we know what the institutional investor, what the processes that they will go through to to select and approve a product. And so really, when we started, we did design with the institution in mind. We had to start from scratch. We'd probably do it exactly the same way, insofar as that we wanted to be able to, institutions to be able to check a box next to each of their concerns about the target investment. I would say what's different and how we've adapted more recently is that we recognize that this is actually this is new technology. It's complex, and so we see our role as a sort of a guide to the institutional investor to be able to help them on this journey, this investment journey, by producing research in a format that they're used to seeing from traditional finance, and also portfolio analysis. And the kind of documents that they're used to consuming, making those available for digital assets, and really I think that's the big shift. I think it's actually it's good that they weren't ready from day one, because now these products have got track record. Our Bitcoin product BTC is now. It's going into its fifth year this year. So they it started in 2020. 4 years. It's going into its fifth year, and so this is helpful for the institutional investor that likes to see a certain amount of assets under management and also a track record.
Michelle?
So one of the things that's interesting is when BitReserve, the company I was at previously, started in 2013, and it's similar to companies I still see now, understanding the lane in which they're swimming, and people will get investment because people are investing again, and they have an idea for a product, they build for 6 months, 9 months, 3 months, however long, then they go and say, okay, we're ready to go to market. They haven't vetted compliance, the regulatory landscape, how they connect to fiat, how they're going to on and off-ramp, how they're going to KYC, and all of a sudden it goes from we're ready, we have a timeline, to this product can't go anywhere because it can't connect. And I think those hurdles are reducing, but it's still something I see in quite a few companies that come to me personally for advice, or Taxbit sees, well, we built this thing, so help us make it work. But they didn't realize that, to the mention of FTX and others, there is value associated. And if it's real or conceptual value in different token economics or traditional cryptos, without thinking through the hurdles that you have to go through for consumer protection, for investor protection, they're going to just be stuck at, we've got a great product, but we can't bring it to market.
Darren?
I think I kind of agree with some of Bradley's comments there. Regards to our business, I think when 2018 Nomura decided that there wasn't a solution fit for purpose that ticked all the boxes for institutions, and said, look, let's build one with some key partners. I think the custody business, and certainly what we've been looking at, wouldn't be drastically changed from where we are right now, because we're solving a problem. The problem is that how does an institution even think about storing digital assets, backup keys, and everything that would normally be all the pain points. But I think from a industry perspective, and maybe this is just really going back to kind of my TradFi experience specifically on the hedge fund side, I've always found it fascinating that exchanges hold client assets. And for me, it was a red flag from the very beginning. I understand the reason why it was a retail-driven business, but that is not an institutional model. So I think if we could go back to the beginning, I think there's benefit on having segregation of duties where an exchange is a price discovery mechanism, buyers and sellers come together, etc. They become experts in their field for all the reasons. And then you have a custodian that is then holding client assets, that's performing the settlement facility. And there's lots of debate, how that could potentially pan out with regards to mechanics on that. But for me, that is the fundamental, if we could turn back the clock. And it would solve so many problems with regards to commingling of client assets, omnibus wallets, which are very standard in maybe TradFi. But when you look on-chain and you are commingling assets, and you don't have proof of verification on chain of where your assets are, you then run into problems of, is there an asset liability mismatch between that omnibus wallet at that exchange? And unfortunately, we've seen a number of examples of that pan out. So for me, I think as I say, from a custody business, we're just solving a problem, and we wouldn't be doing anything too differently from what we're doing right now. But I think from a market infrastructure perspective, I think starting from a model where you have segregation of custody and price discovery as exchange.
Thank you, Darren. On this panel, we have expertise in digital asset management, digital accounting and taxation, trading, and custody. So according to your expertise and background, what are the key growth areas this year or going forward you think in the next couple of years, like couple of important key areas of growth in your opinion? I'll start with you.
I'm from Baltimore, Maryland, in the United States, pardon me. And maybe the only famous person from Baltimore is Edgar Allan Poe. He wrote a lot of very famous stories. So maybe a less famous one is called The Purloined Letter. And pardon me, in the story, there's a letter that would have disastrous consequences for the protagonist. And it's very important this letter never come to light. And the way that it avoids detection is the protagonist puts the letter on top of a desk among a bunch of other letters, and no one ever notices it. I think in the growth opportunity in digital assets, the purloined letter in digital assets is stablecoins. I think stablecoins are what will onboard the whole world to digital assets. If you saw Brian Moynihan, the CEO of Bank of America, he was at Davos recently. In an interview, they asked him about crypto, and he said, the minute we're allowed to be in crypto, we will be there. We will be there in payments. That's their number one focus. So he's ready to go. Same with BNY Mellon. BNY Mellon, I saw the head of their ETF business recently. I asked him what they were doing on custody, and he said, the minute we're allowed to do custody without getting in trouble with a bank regulator, we're already ready. We have it all programmed, we're ready to go. So stablecoins is the right place to start. Some of you probably know this, I bet the panel knows this, but Tether, the largest stablecoin provider, reported $13 billion in profits in 2024. Some of that was gains on Bitcoin they owned, but $7 billion of that was from income from treasuries. Tether has 100 employees. BlackRock reported about the same profit. They have 20,000 employees. I think that gets the attention of any global institution in the world. I think every global bank will have to consider maybe we should have a stable coin, and they will. So I don't know if they all do, but I think there'll be many competitors to Tether as soon as it's allowed, as soon as we get regulatory clarity. And I think that's what onboards everything else.
Matt?
Probably talking our own book a little bit here in terms of the growth opportunity and probably near and dear topics to Jennifer and Bradley, who are already in the space and doing it well. The asset class in itself is, as we know, a potential minefield in terms of, meme coins and potential scams and things like that. We think, and I think the growth opportunity in this space is around trusted investment advice and providing trusted investment advice in a very similar way to the way that we navigate on behalf of our clients in lots and lots of other asset classes.
Bradley?
Well, I think 2025 is definitely shaping up to be a standout year in the history of crypto. I think, look, there's a lot of wonderful projects out there and that are adding value and are getting the attention of the investor. But ultimately, I think this year is going to. I think Bitcoin is going to be it's going to be a standout year for Bitcoin in particular, and that is just because of what we're seeing both in the macro environment. I mean, this weekend aside with the tariff-related slide that we saw in the Bitcoin price and other cryptocurrencies. But I think that aside, we're seeing governments that are looking to invest in Bitcoin as a treasury, as a strategic asset. We're seeing corporations that are investing in Bitcoin as a treasury asset. And of course, the retail investors are already there. And this is also potentially a year when the institutional investors begins to invest as well into the asset class. And Bitcoin is always going to be first on their list. So I think the demand side of this equation is just going to be standout this year. And that comes on the back of 165% return in 2023, 122% in 2024. Already this is a standout investment in terms of an investable asset. At the same time, we've got all this on-chain, the scarcity of Bitcoin on the supply side of the equation, which is just ramping up in terms of the effects of the halving being felt. Also, the liquidity of the asset, people not wanting to. The balances on exchanges have been falling precipitously over the last few months because people only put balances onto exchange when they want to sell, and no one wants to sell. And so I think this is going to be a huge year for Bitcoin in particular. And
Brad, because you mentioned, are you seeing more countries looking at Bitcoin as a treasury asset? Is it the case? Do you think so?
Sorry,
more countries are looking Bitcoin as like a treasury asset or something.
Absolutely, yeah. So you've got the corporates who are doing it, and then you've got the countries as well. We saw recently that the Czech Republic was looking, very, very seriously at that. And I think this is, the US has announced that they're going to have the strategic reserve of Bitcoin. There's an opportunity for all these countries to legally front run this massive trade, right? And so honestly, why wouldn't you? If you have got the mindset and the flexibility to do that, why would you not? And at least, you don't have to bet the whole farm on it, but at least put part of the reserve into, for me, it makes sense.
Michelle?
I have two. So I think the industry has a responsibility to help educate and understand, to the point of meme coins recently, having been through now 11 years of ups and downs. When I was at a consumer product, I've seen people lose everything multiple times, and it is devastating to see that happen when I believe in the future of this industry. So one thing that I look to everyone on the panel for your teams is to help educate and hold accountable projects that are not bringing forward the maturation of the entire industry. So that's my one soapbox. I think one of the interesting things is really payments, stable coins are something that we're seeing quite a bit, and it is a point where as soon as that flips in the US, quite a few of our off-record clients become on record because they have projects that they've been incubating. The US, I think we have 9 or 12 states that have also announced Bitcoin reserves. They all need an accounting product, so obviously those conversations have been very busy since early January. But it's all seeing how, not discussing the asset class, but it's faster, better, more transparent financial services is where I think things are going.
Darren?
Yeah, and I agree with everything what the panel has said so far. I think actually payments is a very interesting space, and actually 100% agree on education. It's something we've all been doing for many, many years, and I think that still needs to continue. I think one area that we're focusing a lot, certainly to try and, yet again, solve problems for some of the clients, and I'm surprised it's taken so long, given blockchain technology, is solving the settlement model, which is still very, very clunky. There's no ultimate DVP mechanism. Yeah, there's some great solutions off exchange. So what we're doing is we had a very successful Series B, which was led by Blockstream, using that technology to build out a near real-time settlement system, which will alleviate a lot of the problems that we're currently seeing. Because it is kind of weird if you think, we're all using blockchain for all the right reasons, and bankruptcy, trust, remoteness, on-chain verification, but the actual settlement process is still very clunky, specifically on some chains. So we want to try and unify that and bring that across not only crypto, but also traditional assets as well. And there's some regulatory challenges and regulatory licenses needed, but I think where we'll see this year in particular is real focus certainly on bringing the efficiency of settlement to a level where it should always be given the blockchain. And then we can look to things that are very interesting, like margining, where we can do cross-asset margining for different various counterparties, still acting as a custodian. We're not acting as a prime broker, still have that segregation. that's where I think is going to be the big push for this year, for sure.
And although we already touched on the topic about different regions taking a lead in regulation and providing that sort of environment to crypto entrepreneurs, Dan, I'll start with you. Which regions, in your opinion, are taking a lead in providing that sort of environment to crypto firms and entrepreneurs?
Yeah, I mean, we're seeing a lot of growth in all different types of client bases. Crypto funds in particular are trying to be very capital efficient, but I think as one of the panelists said, what's the point of having a fund if you can't outperform the underlying asset? So you need to start adding alpha. But with regards to other counterparties, we're seeing a lot of corporates, in addition to other side of the business, which include governments as well. So, and it's not just holding of seized assets, but actually governments contemplating holding treasury reserves, as well as central banks as well.
And if you compare different regions, geographical locations, like Middle East, Europe, US, and Asia, which regions do you think are outperforming other? We already mentioned that some are still lagging behind, but we're seeing some sort of regulatory clarity in different regions. So in your opinion, which regions are kind of taking a lead now?
Is that for me or?
Yeah, I'll ask everyone. Yeah.
Okay, so I guess from jurisdictions are taking lead. So the UAE has been particularly proactive of setting out a very defined crypto framework. They have a benefit of obviously a lot of capital, a lot of wealth through sovereign wealth funds. So we're seeing a significant amount of growth in the UAE. Europe has been slightly lagging behind because of lack of regulatory clarity with MiCA, but that is now, hopefully we are now starting to see the benefits of that. So for me, I think it's been still driven mostly in out of APAC. A lot of volume there, a lot of crypto trading funds setting up. But I think the UAE, in particular the Middle East, is very interesting for just simply having their own regulatory framework.
Michelle, you ask.
So by order of magnitude, UAE is very interesting. Europe, obviously, we have MiCA. Brazil is a huge market that we see potential. Singapore just signed up for CARF. US, while we're playing catch up, hopefully we will move quickly. And then beyond that, there's quite a few other countries or regulators that are telling us behind the scenes they're waiting to see what topples. But something you mentioned earlier, seized assets is something that is very top of mind for governments everywhere. The US Treasury is the largest holder of Bitcoin globally, and those are seized. So it's something that regulators are watching, and then they're looking at those 5 to 6 main to see how the adoption, and then probably 0 to 1 learn their mistakes and headaches.
Bradley?
Yeah, it's an interesting one. I mean, even though the US, with the launch of the ETFs last year was later than Europe, we got to see the magnitude of the US investor base and the size of the wallet over there, with the most successful ETFs ever launched, the Bitcoin ETFs that were launched, and they sort of leapfrogged the Europe in terms of assets under management. Bitwise in Europe, we issued out of Germany. Germany has been we BaFin regulated, so Germany has been one of the more forward-looking and open countries, along with Switzerland, Sweden as well. Whereas in the UK we're still waiting for the FCA to change their mind about poor decisions in the past, and hopefully that will happen this year. But I agree as well. Middle East is a very a very active and growing region in the world of crypto, and also Asia is just starting to. We've announced that the first crypto ETFs will be listed in Hong Kong, this year as well. So,
Matt?
So right from the start, I think we've chosen to focus on where the center of mass is for our clients, and that is in the US. So whilst there's evolving landscapes around the world, where we've been focusing is where our clients are based and where they're thinking about it and tackling and approaching building products or thinking about building products for them. So we're very much focused in the US.
Jennifer?
Bilal, I have nothing to add on that. Can I mention something else?
Please go.
If you haven't already, check out AI agents. That's one of the hottest narratives in crypto right now. But I think everyone would agree, I think we're in a new technological revolution. I think we've left the information age. We're on to a new age. AI is clearly a leader in it, but crypto plays a role. So AI XBT is an AI agent that was built on the Virtuals platform, which is something we own in our fund. Virtuals has a token called Virtual. But it's a no-code platform where anyone can create an agent. But someone created this crypto research agent that I talked to another fund manager recently who told me that he considers it a free analyst for him for liquid tokens. But you can follow it on Twitter. It has interesting takes on things, but it's super fast. And if you own enough virtual tokens, or AIXBT tokens, excuse me, you can ask it to do research for you directly. There's another one called AI16Z that is a play on A16Z, the venture capital firm. They've been asked to rebrand. They're rebranding to ELIZA because A16Z didn't like it too much, but also very interesting token. They're currently working on taking that AI agent and making it into a robot. I'm completely serious. They're taking pre-orders for $420,000. You can have your own ELIZA AI agent robot. But there's a lot of really interesting innovation going on in AI agents in crypto.
Since we are running out of time, just one line from each and every one of you. What would be your message to new entrepreneurs who are building institutional level crypto products?
This has been the refrain ever since I've been focused on crypto, which is real use cases. We just need real, real value brought to people using them. That's the most important thing we don't have very much of currently outside of finance.
Matt?
I'd say I've seen lots of great ideas that haven't necessarily thought about the operating framework that they'd need to work in, particularly around things like liquidity provision, etc. So I'd encourage people to engage early, but also to think about the space that sits around their ideas, like liquidity, like compliance, like integration, because often great ideas that are missing those elements can fail.
Right.
My advice would be to get involved. There's an adoption curve, and we're moving along it. And of course, the returns will get lower over time. And right now, there's a lot of information out there. There's a lot of research. So if you're sitting on the sidelines and thinking about it, I would just get involved, take the plunge.
Michelle?
Don't try and boil the ocean. Keep it simple.
Perfect. Dan?
Education. I think that's. I think you kind of highlighted that earlier on. There is still way too many different ways of explaining something which should be so simple. And I think we all need to be way more involved in kind of getting that message across, because there's a lot of noise out there that we need to kind of disregard.
Well, thank you very much for your insightful discussion, and thanks for staying with us. Have a great day. Thanks.